So the strategy I'm about to share with you has generated a 661% return without having to time the market. So in other words, with this strategy, you don't have to worry about trying to buy stocks at the perfect time because let's face it, no one really knows what the stock market is really gonna do. So what I'm about to show you is a simple method, not for buying stocks at the perfect time every time, but at buying at the right time on average. Unless of course, you don't have time for that. And to prove that it works, I'm gonna show you all my data. I'm gonna show you stock market data from the last 34 years and how this strategy consistently compares to trying to time the market and buying at the perfect time. And just to keep things interesting, I'll also show this strategy against the opposite and buying at the absolute worst possible time. And as a bonus, I'm gonna share with you the exact spreadsheet that I'm using that you can copy and use for yourself, all in return for smashing that like button for the YouTube algorithm. Ready to see how it's done? I'm excited, and I hope you are too. Let's do it. So I'm gonna share with you 3 scenarios. The perfect timing strategy, assuming that you bought at all the right times. The worst timing strategy, where it assumes that you bought at the absolute worst times. And the no timing strategy is what I use, and it's really used to set it and forget it. So the perfect timing strategy got a 892% return. The worst timing strategy, a 258% return. Not too shabby. And finally, the no timing strategy, that's actually not the technical term for the strategy, but I'm gonna save the geeking out for a little bit later. So the no timing strategy would have gotten you a 661% return. So using real market data, which I'm gonna link to below, these are the market returns for the last 34 years from the S&P 500.
What's the S&P 500?
And what?
Hey, what's the S&P 500?
Sorry. The S&P 500 is a stock market index tracking the performance of 500 large companies publicly traded on US stock markets. So before I was interrupted, let's see how these 3 scenarios play out now in 2022 all the way back to 1988. So in the perfect timing scenario, you would have bought in stocks at the lowest of the lows after 5 market crashes. The 2000 dot-com crash, the 2008 financial crash, and 3 mini crashes in 2018, 2020, and 2021. So in the first scenario, my spreadsheet shows what would happen in the perfect timing scenario. In other words, if you completely avoided the crashes and bought in right at the bottom, right when prices are starting to increase. In the second scenario, the worst timing scenario, you would have bought in right at the top before the crash. So you would have bought in at the worst possible price. And then finally, the third scenario, the no timing scenario, where you bought in at regular intervals the entire time, crash or no crash. The results are pretty insane, but I'm gonna show you how to take the emotions out of buying into the stock market so you can avoid checking your phone every 30 seconds just to see if you're up or down. You're gonna learn how to use data to make more informed decisions so you can be the smartest person in the room when anybody asks when to buy stock. But what if nobody's asking you about stocks? Well, look, can I just get to the end of this video? Feel free to ask questions in the comments below and click on that like button so other folks can find this, will you? Sorry about that. Okay, so where was I? So I took the monthly returns of the S&P 500 over the last 34 years from 1988 to 2022. Then I assumed that each investor saved $500 every single month for the entire 34 years. In the perfect timing scenario, you would have always waited to buy your stocks at the very lowest points in 2000, 2008, 2018, 2020, and 2022. So as you are waiting for that perfect time to buy, you consistently saved $500 every single month so you can go in at the right time and go all in. If you would have invested like this, you would have ended up with $2,047,847.92 or about an 892% ROI over that 34-year period. In the second scenario, your market timing was absolutely horrible. So you ended up buying right at the top of the market before it crashed. And if you would have invested like this, you would have ended up with $740,013.62 or a 258% ROI at the end of those 34 years. Finally, in the third scenario, this is where our strategy comes into play. Instead of trying to time the market, you just invest it on a regular recurring basis, $500 every single month. This strategy is known as dollar cost averaging. And if you would have invested like this, you would have ended up with $1,572,357.49 or 661% ROI at the end of those 34 years. So remember, all three of these investors contributed $500 every single month for a total of $206,500 over 34 years. And they all invested in the same S&P 500 index fund. So 3 strategies with the exact same amounts, but 3 very different outcomes. Okay, I know that was a lot of information, so let's quickly rewind and recap. Your total contribution is $206,500. Perfect timing scenario, you made $2,047,847,000, 892% ROI. Worst timing scenario, you made $740,013 or a 258% return. And the dollar cost averaging, where you made $1,572,357 or a 661% ROI. To see how I came up with these calculations, I'm giving away all my data, the spreadsheet, and all the calculations if I can get 1,000 likes within the next 24 hours. So smash that like button and subscribe so you can be the first to be notified when I drop it into the description below. And in the meantime, if you want to know how to buy into the S&P 500, there are actually several ways. I recommend educating yourself on low-cost index funds like the Fidelity 500 Index Fund. I like this in particular because it has a very small expense ratio, has no minimum investment, and also pays dividends. So the takeaway is that in all 3 scenarios, you ended up with more money than you started with. So you got out more money than you put in. So either way, it was better to invest than not invest. So today, the market is at some pretty low lows. Will it go lower, or did we already reach the bottom? The truth is, nobody knows, so you're not alone. So the safest bet is, if you are going to invest, is to invest for the long term, do the dollar cost averaging, and smash that like button to get the latest in finance and investing education.